Wendy's. The place you grab a frosty and a spicy chicken sandwich. And in June 2026, its stock exploded, jumping 25% in a single day, and briefly getting halted by the exchange for being too volatile. Not because they invented a new burger. Because people on Reddit decided to make it happen. Yes, Wendy's became a meme stock. So what does that even mean? How did a fast food chain end up in a Reddit trading frenzy, and should you touch it? Let's break down meme stock mania, using the most delicious example we've ever had. Here's what happened. In late June, a thread appeared on the Reddit forum WallStreetBets, the same community that created the GameStop frenzy back in 2021. The rallying cry was simple: save Wendy's. Within a day, mentions of Wendy's ticker exploded over 500% on social platforms. It became the #1 trending stock on StockTwits. The share price rocketed up 25%, then kept swinging so wildly the Nasdaq had to halt trading twice in 2 days. A burger chain worth barely $1 billion was suddenly the most talked about stock in America. But why Wendy's? The answer is a recipe, and it's the same recipe behind almost every meme stock. Meme stocks need 3 ingredients. First, a beaten-down price. Wendy's had drifted to a multi-year low around $6, down over 30% on the year. Cheap enough to feel like a bargain. Second, and this is the key one, high short interest. Roughly 30% of Wendy's available shares were sold short, meaning big investors were betting the stock would fall. That sets up the magic word, a short squeeze. When a heavily shorted stock suddenly rises, those short sellers are forced to buy shares back to limit their losses, which pushes the price up even more, which forces more buying. A feedback loop that can send a stock vertical, fast. Third ingredient, a brand everyone knows. You can't rally a crowd around a company nobody's heard of. But Wendy's? Everybody's got an opinion on Wendy's. Now, here's where it gets interesting, because Wendy's wasn't a totally random target. There was a real story underneath the meme. The company just brought in a new CEO to lead a turnaround. It's expanding into China with a deal for up to 1,000 new restaurants. And the big one, billionaire activist investor Nelson Peltz, already Wendy's largest shareholder, has reportedly been trying to raise money to buy the whole company and take it private. So Reddit wasn't just gambling on a logo. They spotted a beaten-down stock, heavy short interest, and a potential buyout catalyst. That's a genuinely spicy setup. But, and this is the part the hype skips, a good story and a good investment are not the same thing. Because here's the uncomfortable reality underneath the frosty. Wendy's actual business is struggling. US same-store sales fell nearly 8%. Net income dropped over 40% year over year. Profit margins are getting squeezed by rising beef and labor costs. The stock going up 25% in a day did absolutely nothing to fix any of that. And that's the core lesson of meme stocks: a viral rally changes the price, not the business. It doesn't add customers, fix the balance sheet, or sell more burgers. Wall Street analysts, looking at the fundamentals rather than the memes, mostly rate the stock a hold, with an average price target barely above where it started. The crowd sees a rocket. The spreadsheet sees a struggling burger chain. So what actually happens to people who chase these? History is brutal here. GameStop went from under $5 to nearly $500, and most people who bought the hype near the top lost badly when it crashed back down. Meme rallies rise fast and fall faster, because they're built on attention, not earnings. And when the mood shifts, a bad earnings report, the buyout falling through, or the crowd just moving to the next ticker, the exits get crowded and ugly. The people who make money are usually the early ones and the lucky ones. The people who lose are usually the ones who saw it trending, felt the fear of missing out, and bought it late. Attention is real. But attention is not value. So, is Wendy's a meme stock now? For this moment, absolutely. It's got the beaten-down price, the massive short interest, the recognizable brand, and a genuine buyout wildcard. That makes it thrilling. It also makes it a gamble, not an investment, and those are very different things. If you find this stuff fun to watch, enjoy the show. Just never confuse a viral rally with a healthy business, and never bet money you can't afford to lose on a Reddit thread. This is educational, not financial advice. Always do your own research. If you like the clear, no hype version of the market's wildest moments, subscribe and maybe grab a frosty while you're at it.